All right, everybody, welcome back. It's episode 136 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, we are live at the CAMLA Ontario Expo. We are here. It's very loud.
The way you open that sounds like a New Year's Eve. That's
really?
what comes to mind. When
okay.
Like, we're live here in Times
New
Square.
York City, yeah.
The ball's going to be dropping in
Dundas Square.
Yeah.
Let's call it Dundas Square. You get to check it out for the first time last night. I was surprised you hadn't been to Dundas Square, but...
No, it was not notably, but it was cool. I actually had that little moment. I was like, wow, there are all these screens here.
You were like a kid in a candy shop there, right?
I was
like
pretty excited.
You were looking at all the signs and all the crazies on the streets, but... Neal, what do you think so far? We're one episode in of 5. We just had our buddy Brian Suta, partner with Leadout Capital. Really cool business.
Yep.
What stood out with you for you on the interview with Brian?
We had a bottle of wine last night. That's probably what's standing out for me right now. But
a little foggy this morning.
Yeah, and that Brian's also the fastest man on the earth.
Holy smokes! Yeah. Sub 3-hour marathon.
Psychotic.
Yeah, that's pretty impressive. But cool business, eh? Leadout.
Yeah, very
cool different than most people we've interviewed before.
Yeah, I think honestly, we could do another episode with him and get a lot more detail. But he was cool to share some of the deals that he works on. Just, likely protein powder that you're eating, he probably is financing.
Yep.
And he will say a lot of terms that I think I hopefully we were able to break down to make it a little more consumable.
Yeah, absolutely.
But I think it's a great way to learn. So I think this is a good episode.
Yeah, background in banking with Street Capital, which became RFA, and they're still actively involved in the mortgage space, primarily lending to other lenders and mix as well, about 50% of their portfolio. But like you said, Neal, they're basically a corporate lender, right? They're lending to different corporations and helping them scale. So, and industry agnostic, he put it as well. So, very, very interesting business.
Yeah, check it out, guys.
Cheers.
Hey, everyone. Thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neal Andrino and Ryan McNeil. Enjoy.
All right, we're here with Brian Suta, partner at Leadout Capital. Brian, how you doing today, man?
Really good, gents. Thanks for the invite.
Yeah, glad to finally get you on the pod. We've been in touch for a while now. It's been close to 3 years, I think. So
now, is this the Ryan and Neal pod or the Neal and Ryan pod? I can't. You guys say it differently when I listen to it.
I don't. It's the Canadian Private Lenders pod.
Exactly.
We don't need to put names up front. We got you here though. That's what's important.
Yeah.
But we want to hear all about Leadout. So why don't you take us back and go back to kind of how you came into the space? I know you guys are partly in the mortgage space, but you kind of dabble in a bunch of different things. You're involved with mix and different aspects there. So take us back to the start. How'd you come into the space? Tell us all about Leadout. Let's kick it off that way.
Yeah, I can go back to my origin story in the mortgage space. Like many, you don't necessarily find yourself, realize you're going to end up in the mortgage space, except for maybe you. I'm a CPA accountant by trade. I got my mortgage license, funny enough, in university, just as, being interested in treasury capital markets, liking the space, got my mortgage license, started doing deals. Finished my CTA in industry, and then mixed together mortgage experience with the CPA. Got a job at what was Street Capital Financial as a treasury analyst. Okay. So this is pre-bank days. Worked there for 6 years. Street Capital Financial turned into Street Capital Bank through the bank license. Got acquired and taken private by RFA. I spent my last 4 years as director, treasury and capital markets, really covering all areas of the mortgage space. We were doing securitization, full trades, origination for balance sheet. Then through the bank license, had in GIC sales, hedging, trading, all the fun OSFI related items.
Okay.
Left banking, like you do after you've kind of run your course through the OSFI regulated space. I'd spent 2 years consulting, very much in the OSC, REIT, SMIC, LPGP structures. It was a strategy in capital markets. And then during that time, met my current partner, Yuval Bavli, who had started Leadout Capital, really focused on serving the corporate space, mostly in real estate. So corporate real estate debt. As you guys would know, for REITs or established asset managers, it's very hard to get bank debt, really just like mortgage and that's it. So he had launched a product very focused on providing kind of bridging for capital to good covenant proofs with good collateral and operational control. So left consulting, and we started growing Leadout Capital from there. And it's been a great couple of years growing really organically in the space, founding our fund, Leadout Capital LP, and now sitting as kind of a emerging lender in the small to mid-sized corporate space.
Just some really
Interesting. I'm going to hop right into a couple. Well, you said a bunch of really cool things. One thing that stuck in my head was you said the REITs struggle to get institutional capital. In my head, it's like Boardwalk has all their financing with CIBC at prime minus 400. Is that not the case?
So I'd say REITs have no issues getting mortgages, right?
Okay.
Like you get a mortgage, no problem. But then you still are a business. Like a REIT is a business at heart. So they need operational capital.
True.
And that's where, you use REIT as a general example in the mortgage space. MIC there's another example. REIT is a real estate space. MIC in the mortgage space.
Yeah.
And then just manufacturing, operators, advisors in the general corporate market, all these new and growing firms, great firms, good collateral, good business story. Just the banks are not neglecting them, but they're falling through the cracks of the banks for whatever reason. And that's where our fund steps in to provide them that, non-dilutive growth capital to help get them to that next stage of the business.
Nice. Interesting.
So you're primarily lending to businesses.
Exactly. We call our fund a corporate debt fund.
Okay.
We are industry agnostic and really specialized in nature, so we can go cross-border, cross-industry, cross-asset class.
Okay.
And we've structured that way to serve our investors to be able to go where the best, risk-adjusted returns and demand in the market is. But we, being in Canada, we do fall a lot back to the real estate mortgage space, because that is a large part of our economy and a large part of the growth across the financial sector.
What percentage of your portfolio would be in mortgages, would you say?
As of Q1, it was 48%
Okay.
of our book was lending to mortgage funds or mortgage-related industries.
Okay.
And then the other half was industry-agnostic corporate debt. We have a pharma company on the books, wealth manager that we help do some M&A, advisory firm. We have a tech firm.
Okay.
So it's half the book right now, and it's been like this for a while. Half the book is kind of mortgage focused, and the other half falls to corporate opportunities we're seeing that just fall outside the bank, either for speed of transaction or just they're a little too new or they're cross-border, but still really bankable style deals that we're coming in with that non-diluted capital.
What experience did you have that drove you to feel like this marketplace required the capital? Like, I guess, again, I have limited exposure, so this would never even cross my mind as a pool that would be available, but obviously there's a massive amount of demand. Was there a specific instance where you're like, how is there not somebody for this?
It kind of comes to the general structure of the Canadian banking system, right? We have a number of banks, all the big four, the big five, or the big six, which are ones you add in, that really control the entire lending space.
Yeah.
So if you're not if you're not getting capital from them for whatever reason, it's either you need it too fast, or you're too new, or you're not quite profitable, but doesn't mean you don't have great covenant and great personal net worth backing you up.
Yeah.
You just get declined. And at that point, there's very few options. Either you're raising equity, or you're getting some like high yielding asset-based lending or factoring. Like there's some options in Canada, but there's really no mid-tier, smaller market corporate lender, and that's the gap we're trying to fill, which is very we call like you guys probably have it as well. You want to get into like good situations with your capital as a lender.
Yep.
So we're helping companies grow, meet their demand, help their customers. And at the same time, we're bringing good risk-adjusted returns to our investors in our limited partnerships to help, not get into bad situations or solve people's problems, but to really help growth across Canada.
Makes sense.
So a lot of what you're doing, it sounds like 40-50% of your portfolio is being a lender who lends to lenders.
Yeah.
So let's talk a little bit more about that. Like, how does that work? How do you typically prefer to structure it? Like, are you on title? Are you lending to them through a credit facility? Like, can you kind of talk about a little bit more about the product?
Yeah, very similar to bank level financing, how BMO, TD, RBC does it. There's BMO right there. We can wave to him.
Our buddy Hector Briano from River Rock just walked by.
So you guys run a fund, and you've been doing well with capital raising leverage, but most funds that enter the market, they're 20, 30, 40, even 50, 60 million, they're just not quite big enough to get bank financing. They're either too new, the mix of assets is strange, seconds, first, commercial. They're just, the banks, a very tight program who they're giving leverage to as a mortgage lender. So we are using the same principles that the banks are: senior credit with assignment of the mortgage book, and general covenants to make sure the book is growing, the book is healthy. And then we're providing them senior corporate debt that they can use to lend more mortgages, bridge between maturities, bridge between redemptions and capital raising, really provide them that liquidity that they need to grow their mortgage platform, keep the brokers happy, keep the borrowers moving in the right direction.
How are you underwriting that capital to go out to them? Is it you're putting covenants on their lending, or what does that look like?
Exactly. So most of it comes down to the borrowing base. So everything is borrowing base focused, and then that borrowing base is tested and refreshed monthly. Okay. So if you bring me a pool of $10 million of loans, obviously we remove anything that's in arrears and move things that are over 80% LTV, land, stuff that's, got, the general stuff, right?
Yeah.
We're taking out the unknowns of the book and then saying, okay, now you have 8 million of addressable loans and we'll lend you 30, 40% loan to value against that pool.
Got it. You still take out land. It's like in Ontario, the game is land, isn't it?
Yeah, right now we don't have any land in our borrowing basis today. If someone had the right, and we are flexible in how we structure these to fit the borrower's needs, but land has been pretty much skating sideways for the last few years. So we've been, as the conservative fund, just removing that from our underwriting.
I think it's smart.
How has Leadout evolved in the last couple of years? So are you guys kind of where you expected to be, or does it look completely different than what you anticipated a couple of years ago?
It's funny, we didn't expect to be so focused in the mortgage space. Like with my mortgage background and Yuval, my partner, he had spent time at the commercial bank lending to mix as well. We knew that was a great focus for us, but we didn't think it would come blow up so quick. And we've been, luckily this spring, we've been seeing a lot of demand. Most of our borrowers have been requesting capital. They've been growing their books, which is very accretive for everybody, right? We grow our book with them. They grow their book. Their investors win. Our investors win. We're solving solutions for underlying borrowers in the markets. Though we've been reflecting recently, after the audit closes, you have time to reflect, as you guys probably did too. It's been a lot of organic growth. Like, it's just been going where the capital is required and where we can meet our mandate for investors. So we're not focused on any, we must be this number, we must do this number of borrowers. It is really flowing with the market to find deals that make sense for our platform, that we can, have that win-win scenario where our borrowers are getting what they need and then our investor group is getting what they need on the return side.
Are you a private mortgage lender in Ontario looking for trusted legal support? Meet Grecky Carter Professional Corporation, a boutique real estate law firm in Midtown Toronto with deep expertise in private lending and mortgage enforcement. Grecky Carter closes hundreds of private mortgage deals every year, and when recovery becomes necessary, they handle both contested and uncontested enforcement with precision, from forbearance agreements to power of sale and cost recovery strategies. For lenders who demand clarity, efficiency, and results, Grecky Carter has you covered. Visit gclaw.ca to learn more and safeguard your private lending investments.
You kind of mentioned it, but are you finding that market is shifting from Ontario to other parts of Canada? I think when we were talking before the mics came on, you said you just did a deal in Winnipeg.
Yes, so we, like you guys like out east, we like Ontario. It is, wherever your backyard is where you like to lend, because I can drive to a site and look at it. So
might take
that
3
makes
hours.
it easier. But we are going cross country. So we just closed our first deal in Winnipeg.
Cool.
I can say the name because we're very excited about their growth. So TWC Nutrition, they're the main brand behind Kaizen Nutrition. If you guys
I've heard Kaizen before,
Yeah, so they're in Costco and in Loblaws, and they're getting on the shelves at Walmart soon. So protein powders, creatines, pre-workouts,
Sweet.
all Canadian made. And they're a good growth story. They had some kind of sideways action during COVID with, supply chain issues, but they're kind of back on the growth path now. And they really were just a group that had great covenant, full factory, great staffing, ready to go. And they didn't have the liquidity they needed to meet the growth targets. So we did a bit of a bundle scenario with, sponsor backing, their senior lender to provide them that growth capital. And now they're we just funded last month. They're already, kicking up orders through a lot of the retailers, and everyone on the podcast go buy Kaizen brand. If you're
Is there crazy margin in protein powder?
It's pretty good. Yeah, it's just like, so if you want to get higher profits, it's really just working capital. Like the more you can have in stock and get on the shelves, because there is a bit of a shelving system. I'm not an expert in, well, we're becoming experts in more of the retail side, but they do need that working capital flow. So that's where we're their senior lender to provide them that capital to get more product in the hands of consumers who love the brand. Like when we first got introduced to the brand, we flew out to Winnipeg, met the whole team, and even talked within our partnership group, and some of our partners like, we love Kaizen. Like I haven't been seeing it as much recently. And just because they were not able to produce to the demand that they had.
That's crazy. That's where I'd heard it from. It's Costco. I'd seen them in Costco.
Costco, it's a whole different beast in the industry, being able to produce the stock that Costco requires. And the rebates, if you don't sell through your stock, Costco is forcing you to mark it down and clear out the stock as quickly as possible. So it's just you get into a different game once you're in Costco, but it also is the biggest volume driver in the country too, right? So that's pretty cool. Would you say there's a particular geography outside of Ontario that you guys will target more so? And are you also exploring going to the States as well, or are you planning to stick within Canada?
No interest in the U.S. right now. I think we have a great market in Canada. We have done cross-border deals. Like we have a deal, we helped a wealth manager do some M&A, and the sponsor backing that deal is U.S., Quebec, Ontario based. We do have some security, multi-jurisdiction, but the U.S. is like our point at the top. Why does this Leadout exist? Because there is an underserved market in Canada that the big banks aren't addressing. I think that's different in the U.S. There's so many regional banks. There's so many just banks in general, right? There's so many that they can fail on a monthly basis that, there's what we are in Canada. There's a bank doing that in the U.S. Funny enough, like similar rates. Like our rates are reasonable. We're around 10%, low teens cost to borrower, which is a lot cheaper than these 15 high teens ABL, or you get some I don't want to get into like the private credit conversation, but private credit we see as high teens with equity participation and more of an equity play where we are our true senior credit focused on collateral and security.
How do you feel comfortable to get the security required to have your rate there? Like, how are you underwriting these? Like, for us, I'll say, like, we can be fairly systematic, and we have deal score sheets that allow us to kind of get a pretty good handle on what the deal looks like. Is it the same for you guys? But I feel like, how would you do that? Because it's so different every deal.
We have a pretty complex underwriting policy. And then we have quite a big team focused on underwriting. So it does break down similarly how you guys do appraisals, and like we do appraisals on equipment. We do testing of P&Ws, work with forwards auditors, and then we're doing searches similar to you but different, like PPSA, litigation. We're kind of tracking down who they are, where they've been, what debt they have today, and really trying to underwrite what we call as conservative positions. So really anything we ever do is under 50% loan to value if you consider their balance sheet, their equipment, the addressable security that we're going after. And then we're providing leverage on that to get the capital in the hands of the borrower, but have a conservative position for us.
Interesting.
So I want to hear a little bit more about your actual fund structure. So I know you guys are not a MIC, or you don't have a MIC set up for your business, correct? But you also advise other MICs. I know you helped us too when we were setting up our MIC as well. So you've got some knowledge base there. So is that something you will explore in the future? Maybe just kind of talk about how you guys are structured from a fund perspective.
Yeah, so spending 2 years consulting for funds, we came into the space with a good set of knowledge to set up the best for us as a general partner and for mainly our investors. So we're a limited partnership, and we really set up to be focused on providing the right cash flow, investment returns, and tax treatment for our corporate and family office investors. So as a limited partnership with, we just went up to 10 on our staff, we provide active business income through to our corporate investors. So lower tax rate than specified investment business or returns you're seeing from doing mortgage yourself or rental income or MFT returns. So that's, we're really focused on maintaining that structure and keeping you guys have the fun is keeping, the investors satisfied with return, tax structure, and reporting is where most of our job falls.
In private lending, time is everything. The faster you move, the faster deals close. At Mortgage Automator, we build a platform that transforms how credit unions and enterprise lenders originate, service, and scale their business. No spreadsheets, no chaos. Just precision, automation, and control. From loan origination to servicing and investor management, every step is seamless so you can focus on what matters most. Growing your portfolio and customer base, not managing it. From AI to compliance and everything in between, Mortgage Automator is trusted by hundreds of private lenders across North America and is the highest-rated platform on G2 and Capterra. Mortgage Automator, powering the future of private lending.
So to break it down a little bit for people listening, you're doing a GP LP setup. So you're the GP,
Yeah.
and then each person that comes on is an LP,
Yeah.
and then you are registering. So the GP is registering against whatever business you're lending to or whatever property you're taking security against.
Yeah, so our main security on every deal is their senior lender. So we're a senior GSA charge in the
Okay.
GSA system
Yeah.
in Ontario, different for different provinces, so USC in the US. And then additional collateral and security pledged, they're registered as required.
Yeah.
And then, all in the name of the LP with all in the name of the GP with the LP flowing securities are audited by M&P annually.
Yeah. So, and again, just keep breaking it down. We haven't really talked about this, but like what GSA, so General Service Agreement, that allows you in the event of, I guess, a liquidity issue or whatever, you can take over effectively the business and the assets to try and reclaim your capital.
Yeah, GSA General Security Agreement.
Yeah.
That's basically on title of the company, right? And we have coverage of accounts, equipment, basically everything that is under the balance sheet of the company.
Yeah.
It will also take in a lot of scenarios share pledges.
Yeah.
So the owners of the company will pledge shares to us. A lot of times our lawyer
Yes.
holds those shares
Okay.
and they're safe. So in the event of default, we can step into the shoes of the ownership
Yeah.
and run the company or have a receiver run that company until we can extract our capital, principal and interest, and close out that loan.
When you're lending to these companies, is that a consideration in your decision? Like we always say when we're lending on a home, it's like, would we buy it for this price? Do you think like that a little bit when you're lending to these companies?
First off, we're very much like bankers. We don't want to get into any scenario that we want to enforce, right? And you guys are the same.
Yes.
But exactly, like we've very simple thesis.
Yeah.
The lights turn off tomorrow,
Yeah.
or if the equity group or the executives get hit by a bus,
Yes.
are we going to get repaid?
Yes.
And if the answer is no, we don't fly.
Okay.
Right? So we're always ready, and we want it to be simple, right? We like to do deals that, you can sell some equipment, or even
Yeah.
can sell the company,
Yeah.
to get out of this deal and repatriate our capital back to the fund.
Just end up with 14 tons of protein powder you got to liquidate.
We have no concerns. The group is so strong that that deal is going to do great.
No, I'm sure.
It's funny. There's it's like a bit of a. You're not really sure how to feel about sometimes. Like we want them to do so well, but so well means they pay us back early. Yeah. Right, so you guys are the same because you're a transitional lender. So you're like, I love you guys. I want to be with you for years.
Yeah.
Then I also want you to leave me.
Yeah.
It's like empty nest syndrome, maybe. I'm not sure.
Yeah, they pay you back, and it's just like, okay, well, where's the next deal? Where's the next deal? We want to get the money back out with you, right? Maybe a couple more before we start wrapping up here. But you talked about a non-mortgage deal, really interesting example there. Can you kind of talk about a mortgage deal that you've closed or a MIC that you've funded in the past that's kind of interesting or a little bit different?
Yeah, there's one that's a great example. We funded them last year. So a private group out of Alberta.
Okay.
Backed by a realtor, so knows the market very well, is lending, in and around the areas that he's comfortable. So great underwriter, great person to back from a valuations, transactional standpoint. It was a referral from one of the banks. He has his own portfolio of 15 million of mortgages, all firsts, mostly fix and flip, and he wants leverage. He's, budding business, 15 million of loans.
Yep.
He wants some leverage. The problem is all the loans are just registered in his name. He's not a MIC, he's not a structure, he's not something that a bank can lend into. So they just said, you have a great business, but we can't lend to you. We know our friends here at Leadout Capital, call them and they can see if they can help. So we really structured a bank-like loan for our borrower. He has a facility up to $5 million, and now he has a book of $20 million of mortgages. And we're very happy. We gave him bank-like security, bank-like underwriting, just slightly different structure than what the banks are comfortable with. So we, as a group, end up with a bank-like loan. He ends up with the liquidity he needs. He did $5 million more of fix and flip mortgages, and all parties are happy. He will not grow to a bank facility, but most likely as he retires or gets older, he winds down our facility, winds down his book, goes more conservative. But that's a great story of how we did a deal that's bank just didn't fit the normal structure.
Can you talk about how you got the security you felt you needed on that?
So we gave him a big hug security-wise. So over the company, the management company, we're first position, GSA, with the assignment of all security under that company. We are registered personally on him, PPSA, so if you pull this credit bureau, yes. And then we have assignment, power of attorney, and backup servicer over all of his loans. So if he did the whole hit by bus there, if he got hit by bus, we can step into his shoes, service those loans to repatriate our capital.
Got it.
And close out the loan that way.
His wife wouldn't even know a difference.
Do you want to go one more, Neal, before we hit Brian with the bonus?
Yeah. This one is something that I act like for everybody is what's your outlook for the marketplace? Predominantly in Ontario, I think. We just talked about this as well before we got on. Every market's so different. Atlantic's been doing okay, but what do you think is happening in Ontario now?
So definitely give the lead in that from my banking days.
Yeah.
I've given up forecasting the market.
Okay.
We did a great post on LinkedIn recently. Our team chatted with all 4 large banks to see what their outlook was on overnight rates and 10-year bond yields. And the 4 banks are in general agreement this year, 2026, it's flat in general. 2027, 2 of the 4 banks say up. And they're not in agreement on how much up. The other 2 of the 4 say flat. So
trending upwards.
To say the banks don't know.
Yeah.
So the expensive economists don't know. We think flat market. I'm not a true believer that rates are going up. I think we'll get through some of these macroeconomical, geopolitical issues that we're in right now, and there won't be the need to raise rates. But maybe it's the way I've given up forecasting because the last 5-6 years, what we've been through, you just have to stay nimble and be ready for the next kind of change in market.
That's a reasonable way to look at it. Do you think it's a good time to buy a condo? It sounds like you might.
I think it is. Yeah, it's.
You guys got a good deal on yours? When did you buy?
Just January, yeah. So
there were some markdowns?
There was. You must have seen. You'll see Colliers send out an email. 200 condos available in the same building.
Oh, yeah.
Right. So there's definitely some softness still in that market. Now, capital, we're seeing, and just like you guys are saying, we're seeing the market come back. Like our borrowers are drawing. We're seeing our borrowing bases come up. Valuations are getting a little more stable. So hopefully and we don't even need it up. We just need stability.
Sure.
Yeah.
Right. To be able to kind of navigate what the next 24 months looks like. So hopefully up.
We're hitting that stability.
Talking with some of the bank commercial teams.
Yep.
They're saying they haven't funded construction in years now. So there will be a lack of condo supply in the market eventually.
That's crazy.
But unsure when that is.
Would you guys lend to a Toronto condo developer right now?
Not our space. If they
The answer's no.
Yeah.
All right, let's wrap up here. Brian, anything else you want to add on Leadout before we give you the bonus question?
I can give a shameless plug. Leadout is sponsoring the Hamilton Marathon this year on November 1st.
Yes.
Amazing.
Runner man.
So we're sponsoring the Pacers. Leadout itself is a cycling term, and that's how Mike Gardner, Yuval, and I met. But pacing is kind of leading out our borrower or our investor. So we're sponsoring the Pacers. November 1st, if you're looking for a challenge, come out to Hamilton, Ontario for a 21 or 42. You can pick the full or the half.
Nice.
That was an amazing segue because my question was going to be on running to you actually for the bonus here. I've got my first 5K race. I've done a couple longer ones in the past, but I've never done a short race. So I've got that coming up on Saturday. But I want to know from your perspective, I've seen you've done a lot of halves, a lot of full marathons. What's the coolest experience you've ever had doing a run?
So recency bias, so I just finished the Paris Marathon.
Cool. So cool.
I beat the lead-out record. So I 2 hours and 51 minutes is the new lead-out record.
That is an insane pace.
That is a psycho pace.
And the best part was I got to start.
That's an okay run on a half marathon.
The best part was I got to start with the pros. So I started right behind the professionals. They were gone quite quickly, but a beautiful race. It sees all the monuments, east and west in Paris, and then
That's cool.
Got to enjoy the cheese and the wine afterwards. So that was my recency bias, but the best run.
Do you know how many sections of Paris you went through on that marathon? How many arrondissements you went through?
It says on the shirt. The shirt has all of them.
That's
I think
awesome.
Just like all of them.
Every single one.
Yeah.
Yeah, every kilometer is a new one. That's super cool.
Do you guys have a leaderboard in the office for times?
We don't. But
Okay.
we need to get this.
Okay.
Yuval is next. Yuval is running for speed November 1st. So
Okay.
if anyone talks to him,
Yes.
Are you faster than Yuval?
right now I am.
Right now,
He's,
but you guys are
he's
close.
motivated. He's motivated.
Amazing. That's awesome.
Very cool.
Brian, anything else you want to add before we wrap here?
No, great to get the opportunity to chat with you guys. You're well into 100 episodes, so congrats on the success for the podcast. And
Thank you.
we have done business together. We've lent together in the past,
have?
and
Yep.
hopefully
We have.
hunting again in the future.
Absolutely.
So
Absolutely.
it's been great.
That's awesome.
Great.
Brian, really appreciate it, man. Great interview. And thanks, everybody, for listening.
Thanks, Brian.
Thanks so much.
Thanks for listening, guys. It's Neal, your co-host and co-founder at Keystone Mortgage Investment Corp. and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan McNeil. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.